If you're feeling confused right now, you're not alone. And if it feels like the market is deliberately trying to give you a heart attack, you're not imagining things. Because silver just did something that leaves traders stunned. In an extremely short window of time, silver was slammed nearly 8% lower. Price was aggressively pushed down into the 70-50 area. This wasn't a gentle pullback. This was a fast emotional flush, the kind that hits when fear takes control. And the psychology was dark. People were selling. The words, "the bull market is over," were spreading fast. Then, just as quickly, the picture flipped. Silver ripped higher in a single session, bouncing more than 3%, clawing its way back toward the 73.80 zone. In a matter of hours, almost half of the drop was erased. Anyone who panic sold into that decline likely exited at the worst possible level. Anyone who chased the bounce probably found themselves underwater just as fast, because this market isn't trending, it's whipping. Price is snapping back and forth like a downed power line. One move traps the bears, the next move traps the bulls, then the roles reverse again. This is not direction. This is design. This is not a trend. This is a trap. This market is engineered to produce maximum pain. Its sole purpose is to shake you out of your position by making you doubt your own judgment. In professional trading circles, this environment has a name: the meat grinder. Anyone using leverage here gets chopped up. In this breakdown, we're going to dissect exactly what's happening, why volatility is being amplified, why the table is being cleared before the real move begins, and why two levels now define the entire battlefield. On the downside, $70. On the upside, $75. Silver is trapped between them. And that zone is a war zone. There is a way to survive this chaos, but if you try to actively trade every swing, odds are you'll lose. If, however, you understand why this is happening, you can turn it to your advantage. Price is moving fast, but it isn't actually going anywhere yet. Right now, the market is hunting liquidity. This is the story of the trap. To understand it, you have to understand psychology. Why did silver collapse so violently? Because banks needed cash. Regulatory pressure forced selling. Once that pressure faded, natural buyers stepped back in and price snapped higher. But look closely at the range. Silver fell from $75, rebounded into the $73 to $74 zone, and stalled. No new highs, no new lows. We're still inside the crime scene. And this middle zone is the most dangerous place to be. This is where algorithms feast on retail traders. When price jumps 3%, FOMO kicks in. It's recovering, I have to buy. Then price slips $2 or $3, panic sets in, and positions get dumped. The order book gets washed. Weak hands are flushed out from both sides. That's the objective. Big players want leveraged positions gone. Completely gone. So price moves $3 up, then $6 down, then $2 back up, over and over, until exhaustion sets in. This volatility is a tax on impatience, and if you're staring at the chart every few minutes, you're paying it. Now zoom out for a second and look at gold. Gold has been calm. It held its support. No violent breakdown. Just slow, steady strength. That tells us something critical. The bigger picture hasn't cracked. Inflation dynamics are still alive. Safe haven demand hasn't disappeared. If gold had collapsed hundreds of dollars, then silver's behavior would be dangerous. But that's not what we're seeing. Gold is stable. Silver is simply overreacting. Down 8%, up 3%. That's not a macro failure. That's silver being silver. And the reason is simple: low volume. When volume drops, price becomes easy to shove around. A single large buy order can push silver $2 higher. A single sell order can knock it $2 lower. The signal is noisy. The mistake is confusing noise for a trend change. There's also a lot of talk about a short squeeze. One moment it's starting, the next it's over, then suddenly it's back on. But real squeezes don't behave like this. Historically, true squeezes don't give you clean pullbacks. They run. What we're watching now isn't a squeeze. It's a positioning battle. Bulls are entrenched near $70. Bears are fortified near $75. Price keeps bouncing between those lines. This is trench warfare. Every day, price inches forward, then retreats. Thousands of dollars change hands around $73. Eventually, one side runs out of ammunition. That's why trading the middle of this range is gambling. Will price hit 75? Maybe. Will it fall back to $70? Maybe. Smart money doesn't guess. Smart money waits for the market to choose a direction. Recent action shows buyers slowly stepping in. That's constructive, but these aren't reckless buyers. Large funds don't chase price in environments like this. They scale in. They use limits. They spread orders across levels. Their goal isn't a daily win. It's building a long-term position. And they see this volatility just as clearly as you do. A conservative fund manager isn't going to deploy $1 billion when price is swinging down 8% one day and up 3% the next. They'll say, I will buy at 72. I wanted to pay 74. That kind of buying doesn't launch rockets, but it builds floors. And that's exactly what's happening now. So don't be surprised if price grinds sideways for a while. When large funds are building positions, they don't want price to explode higher. Their goal isn't to buy expensive silver. Their goal is to accumulate it quietly, slowly. This is why they absorb volatility. This is why, during sharp drops, they're the ones catching the falling knife. Your job is simple. Move with their wind, not against it. Now we need to talk about the leverage trap again, because this is where most people get destroyed. If you opened a leverage position near the $80 area and silver dropped towards $70, you likely got a margin call. Your position was closed. Your capital was wiped out. Yes, price may have bounced afterward, but you weren't there. Leverage kicked you out of the game. And make no mistake, this market is hunting leverage. It's targeting traders who are borrowing money to trade. If you're trading with cash, $70 is just a number and $73 is just a number. Your ounces don't disappear. But if you're on margin, those $3, $5 swings are lethal. The big players know this, so they shake the box. They listen for rattling. If something rattles, that's the target. That's why you shouldn't celebrate too hard when price pops. Yes, higher prices are good, but we are still inside the danger zone. Real volume hasn't fully returned yet. Right now, this market is largely an algorithmic playground, and the algorithms are playing capture the flag with your capital. We're about to map out the technical levels, where the trapdoors are, why $70 support matters so much, why $75 resistance keeps rejecting every rally. Those two levels define the battlefield. Everything in between is noise. Let's define the battlefield clearly. In real warfare, there was a place called No Man's Land, the space between two trenches where no one survives. In silver right now, that zone is between $70 and $75. If you're trading inside that range, you're taking fire from both sides. Bears are shelling from $75, selling every rally. Bulls are firing from $70, buying every dip. And the retail trader is stuck in the middle, trying not to get blown up. This is where we break down the mechanics behind the move. We're going to explain the liquidity sweep, why price had to be pushed down toward 70.50, and why it snapped higher afterward. And we're going to revisit the disconnect between paper price and the physical market. The chart may look chaotic, but the message is clear. The market is compressing. Now here's the critical question. Why did price stop at $70, $50? Why not $68? Why not $65 in dollars? Because $70 is no longer just a number. It has become a structural floor in the global silver market. Not long ago, $70 was resistance. It capped price for weeks. Once that level was broken, the old ceiling became the new floor. This is what traders call a polarity shift, and the market has to test that floor. It has to see if it can carry the weight. That violent drop was the test. Big players jumped on it, tried to break it, but it didn't crack. And that tells us something extremely important. There's a massive pool of limit buy orders sitting at $70. These are not retail orders. Retail panics and sells at $70. These are institutional orders. Pension funds, industrial buyers, sovereign funds. They've drawn a line in the sand. We buy at $70. That gives you a huge advantage. You know where the safety net is. If you buy at $73, your risk is $3. If $70 breaks, the thesis is wrong. But as long as $70 holds, the path of least resistance is higher. Because the market has proven something fundamental, there are more buyers at $70 than sellers. That is the definition of a bull market. So why did the crash happen in the first place? It wasn't just regulation pressure. The real driver was a liquidity sweep. Markets move on liquidity. If a large player wants to buy $100 million worth of silver, they can't just smash the buy button at the current price. There aren't enough sellers. Price spikes, and they get a terrible entry. So what do? They create sellers. Where are sellers hiding? Behind stop-loss orders. Thousands of traders had stops clustered around $72. The algorithms know this. Price gets pushed to $72, then $71, then $70, $50. Stops trigger. Forced selling floods the market. Liquidity appears. And who's there to catch it? The whale. The drop wasn't a collapse. It was a fuel gathering mechanism. Fear was used. Orders were filled. Once the selling pressure was exhausted, price snapped back toward $73. It's a dirty game. It's ruthless. But this is how markets actually work. The sweep is done. The liquidity has been collected. And now the market is lighter. Which brings us to the most important question of all. While paper price was being whipped back and forth, what happened in the physical market? Did physical silver really drop to $70? No, it didn't. When spot was pushed to $70.50, physical dealers didn't cut prices. In many cases, premiums increased. Why? Because they didn't believe the drop. They knew it was a paper flush. And they had no interest in dumping inventory just because an algorithm in New York was throwing a tantrum. Street prices stayed near the $90 zone. That is a massive signal. It tells us the real world has separated from the paper world. Paper prices can swing down 8% and up 3% in a day. The physical market doesn't behave that way. Physical silver is priced for scarcity, and scarcity is stable. If you hold physical metal, don't let the spot chart mess with your head. Look at dealer pricing. That's where real value lives, and that value didn't collapse. Dealers see the metal flow, and their message is clear. We're not lowering the price. Now let's talk about mining stocks, because this is where things start to look confusing. Miners are struggling right now, and it makes sense. Think about it. How do you value a company when the price of its product swings $8 in 24 hours? Analysts can't build clean models. Are we valuing this company at $70 silver or $80 silver? That uncertainty freezes decision making, and when investors are uncertain, they sell. That's why you often see silver up 3%, while mining stocks lag behind at 1% or 2%. The market doesn't know how to price them yet. But here's the key, that confusion is opportunity. Because the core assumption for miners has changed. Not long ago, the worst case scenario was $25 silver. Today, the worst case scenario is $70 for silver. Let that sink in. Even in a crash scenario, these companies are printing cash. Margins are sitting in the 50-60% range. Yet the equity market is still pricing miners as if a collapse is coming, a collapse that isn't happening. Once volatility cools down, value investors step back in. They run the numbers. They look at balance sheets. They say, wait, this company is trading at a PE of 4, and they buy. Right now, mining stocks are like a spring compressed inside another spring. Now let's shift to the technical picture. Look at the daily candles. After a massive red candle down, price printed a green candle that stayed completely inside the previous day's range. The high was lower, the low was higher. This pattern is called an inside bar. Inside bars signal compression. The market is pausing, breathing, deciding. It's like a spring being squeezed from both ends. Historically, this type of setup resolves with an explosive move. A break to the upside signals buyers are in control. A break to the downside means another test of $70. Right now, silver's boxed in, $70 on the floor, $75 on the ceiling, bouncing off the walls. Trying to predict the break is a mistake. The smarter move is to wait for confirmation. So let's summarize the structure. Floor, $70 ceiling, $75 physical market. Holding near $90 paper price is volatile. The real world is steady. Now we enter a period where price may not move, but stress increases. Because in environments like this, risk doesn't just live on the chart. There's also gap risk. The world doesn't stop spinning when markets pause. Geopolitics continue, conflicts escalate, currencies wobble. If a major headline hits, price doesn't reopen at the same level. It jumps to a new reality. That jump could be higher, it could be lower. That's why this phase demands respect. And once again, gold is our compass. As long as gold holds its structure, silver's volatility is not a breakdown. Gold is the general, silver is the soldier. When the general holds the line, the soldier eventually follows. This brings us back to the bigger picture. The macro thesis is intact. Big money is not selling gold. Central banks, sovereign funds, institutional players are buying dips. If smart money is accumulating gold, then silver's sharp drop was a fake out, not a failure. It was a derivatives event, not a monetary one. Silver simply overreacts. When gold stumbles, silver collapses. But when gold regains strength, silver runs. Right now, gold is strong, consolidating near historic highs. That creates a gravitational pull for silver. And here's the critical metric, the gold to silver ratio. That ratio is hovering near 60. In strong bull markets, it historically compresses toward 30. For that to happen, silver must move twice as fast as gold. As long as gold stays stable, silver has a green light. As long as gold holds above the $4,300 zone, the silver bull thesis remains intact. That level isn't just technical, it's psychological. When gold holds it, sharp silver drops tend to be traps, not trend changes. Now take one more step deeper. Large funds are quietly returning. Pension funds, portfolio managers. The real volume hasn't fully arrived yet. What we've seen so far is just the advance guard. The main force hasn't entered the field. And when volume returns in a tight market, two things happen. Price becomes more directional. Short-term volatility increases, but clarity follows. Institutional buying isn't about pennies. These funds are building positions for the next 5 to 10 years. And when they buy, they don't flip positions the next day. That removes supply from the market permanently. That's why volume will be the real test. Rising volume with rising price sends a clear message. The drop was simply a chance for big players to accumulate cheap silver. But charts aren't the whole story. We also have to look at the global stage. Geopolitical risk is rising. Tensions remain elevated. Critical shipping routes are under threat. Supply chains are fragile. Silver isn't just an investment, it's a strategic metal. It's used in missiles, in satellites, in defense systems. If global conflict escalates, silver stops being optional. Demand shifts overnight. That's why smart money holds silver. In times of war, paper assets collapse. Hard assets move first. Holding cash is a bet on stability. Holding silver is a hedge against chaos. And in the world we're living in, chaos is not a low probability outcome. Before we close this out, I need to give you a warning. In environments like this, you may see strange behavior near market closes. Price can suddenly be pushed lower in the final moments. Long wicks appear, indecision candles form. The goal is simple: make the weekly chart look weak and scare technical traders out of their positions. Smart investors don't fall for that. They don't focus on the last few minutes. They look at the body of the candle. And if that candle body is telling you one thing, price is holding above $70, that's strength. Now let's return to the physical market. While paper prices whip back and forth, physical metal is quietly leaving the system. Reports continue to surface about record withdrawals in Asia. Metal is being bought. Removed from vaults, taken into possession. This isn't day trading, this is accumulation. And these physical outflows put a time limit on paper manipulation. Banks can only control paper prices as long as they have physical metal behind them. When vaults empty, the game ends. And with every dip, more metal is pulled out, accelerating that countdown. Here's the real irony. The trap designed for you is slowly becoming a trap for them. Short-term pressure is being used at the expense of long-term security. That trade-off never ends well. Every piece is now on the table. Gold is holding firm. Institutional money is preparing to move in. Physical supply is disappearing. The setup is almost perfect, but the hardest part still remains. Psychology. How do you stay calm when your account swings 10% in a single day? How do you ignore the noise when headlines scream bubble? How do you avoid selling too early when price finally starts moving your way? This is where most people fail. To survive and thrive, you need psychological armor. So let's talk about how the biggest players think. Does a billionaire buying silver stare at a 1-minute chart? No. Do they panic when price drops $2? No. They play a different game. It's called time arbitrage. Retail traders compete in minutes and hours. Whales compete in years. They understand that silver's structural supply deficit can't be fixed overnight. Opening a new mine takes a decade. New supply doesn't appear on demand. So whales buy now, knowing that scarcity will be far more obvious a few years down the road. Who sells during these drops? The impatient. Who buys? Those looking at decade-long charts. And when price was being sold aggressively near $70, one group was staring at daily candles. The other was staring at the next 10 years. That's the difference. You need to adopt that mindset. Stop asking, what will silver do tomorrow? Start asking, where does silver trade when global debt pushes deeper into unsustainable territory? Ask, where does silver trade when high-tech manufacturers struggle to secure supply? When you extend your time horizon, volatility shrinks, crashes become blips, rallies become trends. Now let's talk exits, because silver isn't meant to be held forever. Silver is bought to preserve wealth. When systems strain, that wealth is rotated into real assets. So what are the targets? Target 1, $85. This is a technical gateway. Once legacy resistance zones are cleared, price pauses here. $85 confirms the new paradigm. At this level, there's no panic, no rush. You hold and let momentum build. Target 2, 100. This is no longer math. It's a media event. Triple digits bring attention, phone calls, frenzy. At this stage, you may choose to pull some initial capital off the table if needed, but the smartest move still isn't finished. Because the real signal isn't price, it's the ratio. When the gold to silver ratio compresses to 30, rotation begins. When it reaches 15, the cycle completes. This strategy protects you from selling too early. It keeps you in the trade until silver becomes historically expensive relative to gold. Right now, that ratio sits near 60, meaning silver remains historically cheap. We're not even halfway through the move. So what's the biggest risk ahead? Not a crash. Selling too soon. And during the hard part, only to exit when the reward phase begins. If you sell near $75, you're leaving before the main course arrives. The largest gains are made in the third phase of a bull market, the mania phase. We're only beginning to enter it. The public is just waking up. Institutions are just positioning. Selling now hands your seat to a pension fund. Don't do that. You've earned the right to be here. So here's the final verdict. This was a trap. It was designed to force you out, and it failed. Price recovered. $70 held. Weekly structure remains strong. Monthly structure looks historic. Long-term signals point toward a supercycle. Banks threw everything they had at this market, and it's still standing. That tells us the truth. Real demand is stronger than manipulation. Physical hands outweigh paper hands. Now breathe. You're positioned correctly. You're holding a shrinking supply. You're holding future money. As volume returns, clarity follows. As large players step in, direction becomes obvious. The trap is empty. The road is open. Welcome to the year of silver. Stay sharp.